Good morning. It's great to see so many people here after a Saturday night in Austin. There's a lot of fun to be had, so thanks for showing up. It's a nice crowd, nice turnout. Today we're going to talk a little bit about the future and present of exchanges. Quick question, how many people are not familiar with a Bitcoin exchange? Okay, good, excellent. So this should be useful for you. So my name is Scott Bambasino. I'm VP of AlphaPoint. AlphaPoint is the premier enterprise platform for digital exchanges. And just a quick shameless plug, some stats here. We power 20 exchanges in 15 countries. In aggregate, they process over 350 million transactions, BTC to USD transactions per month. We power some of the largest exchanges on the planet, including Bitfinex, which is the largest US dollar to Bitcoin exchange on the planet, MexBT out of Latin America, Bit out of the Caribbean, FlowBTC out of Brazil, and many others as well. So let's see. For the purposes of the presentation today, I thought I would put the Bitcoin ecosystem into 4 parts. And the first one is miners. It all starts with miners. They create Bitcoin. They also maintain the network, which enables a person to send a Bitcoin to someone else. With the miners and networks in place and the Bitcoin created, next come the exchanges. Exchanges are where you go to buy and sell a Bitcoin. They are also price discovery mechanisms. So if you want to know what the value of a Bitcoin is, you go to an exchange to discover that. So once you've bought your Bitcoin, you need to be able to store it and you need to be able to use it, and that is the role of wallets. You can think of wallets such as retail wallets like blockchain and Coinbase. There's also institutional wallets like Zappo, BitGo, and others that cater more to the enterprise institutional space. These 3 pillars form the infrastructure of the Bitcoin ecosystem. With these pillars in place, this infrastructure in place, you can then have use cases. You can then build applications on top of this and bring business solutions and solutions to people. One of the most popular and well-known is payment processing. This has become very popular in the space. Companies like BitPay have been very successful. And it's very obvious why merchants would love to adopt Bitcoin. It provides a lot of advantages over legacy networks such as credit card payment networks. And we can see that the traction is going very well with companies like Dell and others now accepting Bitcoin. There's other companies doing well, such as ChangeTip. They are a micro payment and tipping service. They seem to be getting a lot of traction. And I think we're going to see some very exciting applications in the near future. I talk to people all over the globe every day. And one of the things that a lot of people are focused on is remittance. I don't know what the numbers are off the top of my head, but I'm sure they're astronomical when it comes to how much money flows across borders. People from here sending back home, either Mexico, India, Philippines, and it's expensive to do so. And many people believe that Bitcoin will provide a solution that will put more money in the pockets of the people. So I'm looking forward to that. But many believe that that killer app has yet to present itself. Email was the killer app for the internet. It's what made you want to be on the internet. Instead of writing a letter, putting it in an envelope, stamping it, sending it through the mail, email provided something that was instant and free, and your grandmother got it. She could open up her computer, write a message, hit send, and her grandson, granddaughter at college got it instantly. And she got it instantly too. And I believe that that is something that we need to see happen. And I only bring this up because there's still room for a lot of growth, a lot of opportunity. So So exchanges do really well with volume. And that is what is very important to exchanges. They need volume, they need action, they need trading happening. So let's talk a little bit about the history of volume. When you see this chart, probably the first thing that catches your eye are those really high peaks. I'd like to ignore those peaks. And sorry, it's a little hard to see, but from May to October of 2013, you can see a pretty steady line of business there. If you ignore the peak and then just look at that same time period for 2014, you can really see very strong year-over-year growth. And that's very, very important. 2013 was 16 billion, 2014 was 37 billion, but I think the real takeaway is that time period there and how flat or smaller it was in 2013 and that nice, strong year-over-year growth. And we anticipate that to continue. So let's take a look at volume by exchange over time. In the beginning, there was Mt. Gox, and it was the clear leader. You can see here for Q1 and Q2 of 2013, they dominated the market. But then there was a shift, and the following quarter, it was BTC China. They had the most volume per exchange on the planet. And that lasted for 1 quarter. And then Hubei came in, and they had the volume lead for 2 quarters. And then shortly after that, it was OKCoin, and they had it for 1 quarter, and then it flipped right back to BTC China. So there really isn't a clear leader in the space right now as far as volume on exchanges are concerned. So I thought it'd be interesting to talk a little bit about how exchanges make money. And this slide here talks about the exchange fees. So exchanges make money by charging a fee, a transaction fee. Exchanges do transactions, and there's different kinds of transactions. There can be a deposit transaction, a withdrawal transaction. There can be a transaction to trade. And there can be special orders as well. So each of these transactions is what the exchange does for you, and they put fees on these, and that's how they have a business model. And you can see that different exchanges have different fee structures, and that exchanges are becoming more sophisticated, as you can see with Bitfinex. They offer something on the far right that no one else does. And we'll get into more of that in a minute. So looking at what exchanges are capable of doing from a business perspective, not too long ago some interesting information was leaked about Mt. Gox. It was a business plan of theirs, and it included revenue projections. What we were able to gather from this information was the revenue that they generated, and we knew the volume already. So with that, we were able to understand the percentage of revenue per dollar that they were capturing. And we had data from January 2013 to October 2013. We did not have data from November and December of 13 or January and February of 14. So what we were able to do was do an average of the prior 3 months as far as the revenue percentage was concerned. But we did have numbers from volume. And so with that, we were able to understand what kind of revenues they were actually generating. So for 2013, the total was $24 million. But what was interesting is, if you recall earlier, those spikes in volume, the vast majority of that, half of that was in those last 2 months for November and December. So when that volume spiked really high, that was very beneficial to the exchange. So we took that same methodology and applied it to some of the other larger exchanges on the planet. And we can see that from 2013 to 2014, companies like Bitfinex and Bitstamp have seen some strong growth. So if volume is what exchanges need and desire, I guess the next question is, well, what drives volume? So one way to look at it is volatility. Volatility drives volume. We took this from CoinDesk, and I believe the red is the volume, and the blue is the variation in price. And you can see that these lines almost mirror each other. It's almost a direct correlation. You can also see that the volatility has, if you drew some lines there, you'll see it's starting to trend down. And that is because there's more liquidity in the market, and with liquidity, the volatility, it's a little bit harder to move the price. And so that's evident here. So I wanted to talk a little bit about what is perhaps holding back further adoption of Bitcoin. People are clearly embracing it. But what about larger players, institutions, the people with the really big money? There was a comment yesterday I thought was really smart, which was the legitimate money doesn't want to move into Bitcoin because they're afraid it's going to be illegal. And those that are illegitimate don't want to move in because they're afraid it's going to be legal. So I thought that was great. I'm gonna steal that and borrow that a little more often there. So, all right. So with regards to the legitimate people and them moving into Bitcoin, they need to understand what the rules are. If it's unclear, if there's no clarity, they'll just sit on the sidelines. If they go to their compliance officer and say, hey, I want to do something in Bitcoin, or I want to work with this Bitcoin company, their compliance officer is going to go, whoa, hold on. We're not sure what the rules are. We're not sure what the regulations are. We don't know how to be compliant yet. So the bright side of regulation and rules could be that it will allow larger institutions to move into the space. And this helps us visually see where we think it's a little easier to work with Bitcoin, where it's just not outright banned or that people are outright hostile to it. And I believe that it's trending in the direction that there will be greater adoption, more permissiveness, and I certainly don't anticipate Bitcoin being illegal anytime ever. Another concern that institutions have is safety. So traders are inherently comfortable with risk. If they're going to make a bet, make a trade, they're very comfortable taking that risk. What they're not so comfortable with is the possibility of actually losing the deposit that they made. And unfortunately, this is what gets the biggest headlines. Everybody still remembers Mt. Gox, most recently Bitstamp, and a few others. But there is a silver lining in this, and I like to point it out. Bitstamp did get hacked, but because they used best practices and incorporated some good technologies, such as cold storage, they survived. And that is actually a very big step forward in the industry. They did not lose everything. They did not collapse. They made people whole, and they're still in business. And that is a very big positive for the industry. So they should really be applauded for that. So I'd like to talk a little bit about what we can look forward to. You guys may be familiar with these numbers. That $5.3 trillion number is what happens in the foreign exchange markets on a daily basis. That's just a huge number, really mind-blowing. The next number is 2.5 trillion, and that is the CME group. That is the Chicago Mercantile Exchange. And that is where people go to discover the price of commodities such as oil and coffee. In nominal value, there is $2.5 trillion per day traded on the CME. Very, very big numbers. Your traditional stock exchange, such as the New York Stock Exchange, is at $169 billion per day. And then we get to Bitcoin at just 32 million with an M per day. If the FX traders start to pay attention to Bitcoin and they start to, instead of wanting to go from British pounds to US dollars, if they want to start trading British pounds to Bitcoin or US dollars to Bitcoin, and just a fraction of that 5.3 trillion per day starts to flow in Bitcoin's direction, you're going to see a huge jump in volume. Same with the commodities. Again, I talked to a lot of people. There are some very creative people out there that are interested in creating commodities exchanges, so you can go from soybeans to Bitcoin or gold to Bitcoin or oil to Bitcoin and create different mechanisms to do that. Again, if just a fraction of the 2.5 trillion moves in this direction, you're going to see a huge jump. And same with equities. Additional instruments drive volume. So spot transactions make up that 5.3 trillion, and that is 38%. Spot transaction makes up about 100% of Bitcoin transactions. And we can see in the FX market that 42% is really from exchange swaps, foreign swaps, and that's an instrument, a type of instrument. I'm actually a little short on time, so I'm going to move forward here. And we can see where that is divided. It's 41% the UK, 19% the United States, 60% between the two. We bring this up because there's over $1 billion in Forex volume in 50 other countries. And so as Bitcoin goes into these other countries and gains traction, there's a lot of room for growth there as well. Leverage drives volume. It's a very easy concept. If I put $1 in, but I can trade up to 3, that will be very beneficial. Futures and options are instruments that we are starting to see in the space as well. Flexibility drives volume. Currently, you see a lot of limit, market, stop loss, and trailing stop orders. These are the easiest orders. NASDAQ has up to 17 order types. And finally, what it will take for Wall Street adoption. We talked a little bit about security and regulatory clarity. The right side is the technology piece. Advanced protocols such as fix and binary will allow our machines to speak to their machines, and exchanges are getting to that level. It's that enterprise level of sophistication that will enable the big money to come in. And with that, I am only 18 seconds over, so thank you. Thank you, appreciate it.